Welcome to The Explainer. Today, we're going to crack the code on accounting. We're going to dive into the essential, repeatable journal entries that are really the foundation of how any business speaks the language of money.
I want you to think about that for a second. We tend to imagine accounting as this super complex, kind of scary subject. But what if I told you that at its heart, it's just a handful of simple stories that repeat themselves?
Well, it's true. Accounting really is a language. And just like any language, it's all about patterns. Once you learn those basic patterns, you start to become fluent. And that's exactly what we're going to do together today. Okay, let's get right into it. If you remember only one single thing from our time together, please make it this. In every transaction, no exceptions. The business gets something, that's your debit, and at the exact same time it gives something, that's your credit. This one simple idea is the key that unlocks everything else. So with that golden rule fresh in our minds, let's start with our first story. This is the tale of how money finds its way into a business. This right here is about as straightforward as it gets. You do some work for a client and they pay you on the spot. So let's apply our rule. What does the business get? It gets cash. So we debit cash. What did it give? It gave its services, which means it earned revenue. So we credit service revenue. Get and give. See? Simple as that. But, in the real world, you don't always get paid right away. And that brings us to the classic two-part story of a credit sale. First, there's the moment you actually make the sale. And second, there's the moment the customer finally pays you. Two different moments, which means two different journal entries. So in part one of our story, and this is the important part, no cash has actually changed hands yet. But you've still earned the money. So what did the business get? It got a promise from the customer. An IOU. That promise is an asset called accounts receivable, so we debit it. And what did it give? It gave its product or service, so we credit sales revenue. Now for part two, the happy moment when the customer pays their bill. What does the business get this time? It gets the cash, so we debit cash. And what does it give up? It gives up that IOU, that legal right to collect the money. So we credit accounts receivable to reduce the amount the customer owes. And just like that, the story is complete. All right, so we've got the story of money coming in. Now, let's flip the scripts and look at the mirror image, the essential stories of how a business spends its money. Let's start with another simple one, a basic cash payment. A business has to keep the lights on, right? So what does it get? It gets the benefit of electricity and heating for the month. That benefit is what we call an expense. So we debit utilities expense. And to get that benefit, what did it give? It gave cash, so we credit cash. And hey, it works both ways. Just as we sell to customers on credit, we also buy from our suppliers on credit. So here, the business gets inventory that it can sell later. Inventory is an asset, so we debit it. But it hasn't paid for it yet. Instead, it gives a promise to pay the supplier. That promise, that obligation, is a liability called accounts payable, and we credit it. And, of course, here's the follow-up entry. When it's time to pay that supplier's bill, what does the business get? This one's kind of cool. It gets relief. It gets to eliminate that debt it owed. So we debit accounts payable to reduce the liability. And what does it give to get that relief? It gives cash. So we credit cash.
Payroll is another perfect example of a two-part story. Think about it. At the end of a pay period, your employees have already done the work. They've earned their wages. So the business has gotten their labor and talent for the month. That's a salaries expense, so we debit it. But it hasn't paid them yet, so it gives a promise to pay, creating a liability we call salaries payable.
Then, payday finally arrives. The business makes good on its promise. What does it get? It gets to eliminate that salaries payable liability. So, debit salaries payable. And, of course, what does it give to its employees? Cash. So we credit cash. Again, a beautiful two-step narrative. Okay, for our last section, let's zoom out a little. Let's look at some entries that aren't about the daily buying and selling, but are more about time, long-term assets, and the actual financial structure of the business itself. Now, this slide shows two ideas that are perfect mirror images of each other. A prepaid expense is when you pay for something before you use it. Unearned revenue is when a customer pays you before you've done the work. Once you understand one, the other just clicks into place. Let's use an example. Say your business pays for 6 months of rent all at once, up front. Now, the crucial thing here is this is not a rent expense. Not yet. Why? Because you haven't actually used the space for those 6 months. What the business gets is an asset, the right to use that property in the future. We call that prepaid rent. And to get that right, it gives cash. And now for the flip side. A client pays you for a big project before you've even started. The business gets the cash, no doubt, so debit cash. But you haven't done the work, so you haven't earned it. That means it isn't revenue yet. Instead, you've given a promise to do the work later. That promise is a liability, and we call it unearned revenue. So what about a huge purchase, like a new delivery truck? You can't just expense the entire cost in the first month. That would totally distort your financial picture. Instead, you spread that cost out over the truck's useful life. We call that depreciation. Each period, the business gets the benefit of using the truck, so we record a debit to depreciation expense. And it gives up a tiny piece of the truck's value, which we track with a credit to a special account called accumulated depreciation. But where does a business get its start in the first place? Well, it often begins with the owner investing their own money. In this case, the business as its own entity gets cash to get started, so we debit cash. In return, the business gives the owner a stake, or equity in the company. We record this by crediting an account called owner's capital. And naturally, the reverse can also happen. When an owner takes money out of the business for personal use, the business is essentially getting a reduction in the owner's claim on it. We track this by debiting an account often called owner's drawings. And what does the business give? It gives away its cash. Finally, another very common way to get a business going is with a bank loan. The company gets cash from the bank. That's a debit to cash. And, in return, it gives a formal written promise to pay that money back, usually with interest. That liability is called a note payable, so we credit it. And that really is the heart of it all. The journal entries we've walked through aren't just a bunch of random rules to memorize. They are the repeating stories, the very grammar at the core of the language of business. Once you get these, everything else starts to make so much more sense. So the next time you look at a financial statement, try not to see a wall of numbers. Try to see the narrative underneath. Ask yourself, what did this business get, and what did it give? Because at the end of the day, that's the real question we're always trying to answer. What story are your numbers telling?